Hi, everyone. My name is Caroline Scannell. I'm the Director of Brand Development here at Paperchase. I'm based in our New York office, and we've been doing this webinar series for a few sessions now. This is going to be our third session, and we're really just so grateful that you guys have all attended our sessions and that you're all interested in this opportunity. The reason why we're doing this, and before I go into that, let me explain in case you're not familiar with Paperchase. We are probably your restaurant's accountant. We have been doing restaurant accounting and financial services for the hospitality sector for over 30 years. We service so many restaurants across the US, UK, Middle East, and we serve restaurants of all shapes and sizes. Big ones, small ones, successful ones, unsuccessful ones sometimes even. But all of this has made us really knowledgeable on the industry. And we've found in our work that when we're able to share that knowledge and especially educate our teams on the basics of restaurant finance, they're able to do better for their restaurants, but then also grow their careers. And so that's really the goal of these sessions, is to kind of just pass along what we've learned to you all. So I'm going to go ahead and share my screen really quickly. All right. Okay. So today we are going to be covering a P&L review. So we're going to be going pretty in depth into the P&L. This is great for anybody who is totally new to this, but also anybody who's seen a million P&Ls, but just needs a little bit of a refresher. It is definitely a complicated report, but once we dive into it, we're hoping that you'll come away with a lot more confidence in reading these and analyzing them and being able to take action for your own business. So we're going to start off with some introductions. Then we're going to just very quickly give a brief review of some key profitability metrics, which we went over in our first session. If you weren't able to join our first and second Restaurant Finance 101 sessions, we have them on our YouTube page. So you can definitely go and access them there. It's the full recording. And we're also going to be sending out a recording of this session later after the session, and we're also going to send out the P&L that we review, so you'll be able to share that with your team members and with anybody that you have friends, or if you have friends or colleagues who might benefit from this. So we'll go into profitability measurements very quickly, and then we'll jump straight into the P&L review. After that, we'll have a couple 30 minutes open for questions. If anybody wants to ask anything related to restaurants or finance, I dare you to challenge us. Please, just anything that has to do with it. Doesn't even have to do with the P&L, but we're happy to answer any questions. If during the seminar you have a burning question, we ask that mostly you keep your questions for later, but if you have a burning one, you can go ahead and drop it in the chat and I'll address it while Ruhel's speaking. So without further ado, I'd like to introduce my lovely colleague, Ruhel.
Thank you, Caroline, for the introduction. Good morning, everyone. Thank you all for joining Restaurant Finance 101 session, session number 3 here with us this morning. My name is Ruhel. I've been in Paperchase for 8 years, 12 years as an accountant, 15 years in the industry. I have worked at various restaurants and nightclubs prior to joining Paperchase, so I do have some operational experience as well. Hopefully, we'll be able to put the numbers together and be able to talk numbers from an accountant side, also from operation side as well. But excited to be here and thank you all for joining. With that being said, we'd quickly like to go over the profitability metrics, which we covered during our last session. Just want to give you a refresher on what was discussed. At least, these are fresh in your minds as well this morning. And as we drill down on the P&Ls, you'll be able to, obviously, you will see these come up again. So at least hopefully that will be able to help you. So let's start with gross profit. We discussed gross profit. Gross profit is your revenue minus F&B cost. Prime cost is your revenue minus food and beverage cost minus your labor cost. EBITDA, also known as your four-wall EBITDA, is your earnings before interest, tax, depreciation, and amortization. Last but not least is your net profit, which is revenue minus all expenditures, which shows you how your business is doing. What is the health of your business, right? That being said, let's start by looking at a P&L. I'll go ahead and start sharing my screen. All right, here we go. So here we have a standardized paper chase format P&L. We also showed this in our last two sessions as well. And to start off the P&L, we're looking at the index, which is essentially a report card of the business, right? It shows you what the sales are, revenues are, COGS are, year-to-date COGS, also labor, and in the bottom, it gives you some statistics. So obviously, we'll drill down more on this as we go further in the P&L. The following tab is your P&L actual versus budget. So this is something that we strongly recommend all our clients have in Paper Chase. So essentially, it shows your actual numbers against your budget. Budgets are something that if you already have, which is fantastic, we'll definitely incorporate them into your financials. If you do not have a budget created, please let us know. We'll be able to help you and assist in creating one. So just reach out to the accountant that you're working with and we'll be able to guide you there as well. The following tab is the quarterly format. So this essentially just compares quarters. It gives you the actual against the budgeted quarterly financials and also the cumulative. Then of course in the back end, we have the average monthly and the average weekly as well. Also, part of the financial statements, we include the balance sheet by month. So you will see how your company is doing, what is the health of the organization. It shows all your assets, liabilities, and owner equity as well. Again, this is just something that comes with the standardized format. Then we have the P&L schedules, which say, for example, if you want to drill down or your cost of goods sold line, you can come in here, click on the number. It's going to take you to the schedules itself. There you'll be able to see a detailed version of all the expenditures for the month. So that's definitely a cool feature to have. The last couple of tabs are the accrual sheet. So if we're missing an invoice, something we have to take an accrual for, or if your month ends on a Thursday, we had to accrue for the labor for those last 4 days of the month. This is where all the schedules are going to be. So you'll be able to see real time what we're accruing and also reversing. And then we have the prepaid schedule. So if we have an insurance expense that's being amortized or is prepaid in advance, we obviously have the schedules for it, or any bills that are being paid, ahead of time. We obviously have the prepaid schedule that sort of ties back to the actual invoices and shows you the month-over-month expenditures as well. Last but not least for this presentation itself. So this is essentially KPI. It's a summarized version of the P&L. So what we're doing here is taking all the top line. So it's the revenue, your total COGS, your total labor, OpEx, and also your depreciation and amortization. So essentially, we're summarizing the P&L in 5 or 6 lines essentially to give you a quick snapshot of what's to come. I generally like to look at these so that at least it gives me some key points as to what I want to really drill down on. So for example, it's essentially a financial that we have is for a fictional restaurant, and all these figures are very similar to what we see in the industry. Again, we're going to go over the numbers shortly, but we just wanted to quickly take a glimpse of this here together. So if you look at the revenue, the trajectory looks good. It's going up month over month, and our Q1 total is on the last column, right? Also, we have the cost of goods sold, right? And the cost of goods sold percentages as well, which is 20%. So that tells us it's really doing well. Hopefully this is within the budget, right? And achieving a 20% cost of goods sold is definitely remarkable. And again, that's fascinating, the fact that this restaurant was able to achieve that. Following that with the gross profit, so it shows you how you're doing, what the margins are after your cost of goods sold is considered. Following that, we have the labor cost at almost 40%, right? So to me, this is an automatic red flag. We're definitely going to drill down on this together, but this is something that I want to look at, which is why I have it highlighted here. Our prime margin is our prime cost is 59%. So again, after all the expenses, we have 41% margin to work with for all our operating expenses, right? The following that is the OpEx, which is at 38%. That tells us they were almost at break even after all the expenses are considered, which is definitely not something that we want to achieve. We want to achieve a higher margin, of course, right? So again, we'll drill down on the OpEx as well to see where that 38% is driving from. Last but not least is the depreciation amortizations, which will go a little bit more in detail as we go later in the presentation. And to recap, to finalize, we have the net profit, which shows the overall profitability of the company. And that tells you whether obviously we're all in it to make money, of course, right? So that shows you how we're doing as a business and what are our improvement areas is something that we're going to cover up above. So we could all have a larger and greater net profit or bottom line rather, right? So without further ado, let's start looking at the P&L that we're going to be reviewing together. Again, as I mentioned, the way I like to look at P&Ls is different ways of looking at it. The way you all should look at, these P&Ls we have, like I showed you in the previous tabs, you can do a P&L analysis or profit and loss analysis on a month-over-month basis, actual versus budget, quarter-over-quarter, or even year-over-year, right? So it really depends on the type of analysis that you're doing and what type of numbers you want to look at to do different comparisons, etc. Right? So to start off, obviously we have our top line, which is our revenue, right? So our revenues are obviously it's what the business is generating in selling products that we're selling, right? So in the category section, this is obviously a semi-casual restaurant. The categories are catered to that specific client. Again, if you're a coffee shop or a bar or a nightclub or selling high-end cocktails, these GL accounts, these different revenue categories would be different, of course, right? So here we have just our typical food, wine, again, just food and beverage revenue, and then we have our other revenue, which is resi fee, right? Again, that's for cancellation of reservations. If you were a nightclub or a cocktail bar in Miami, you perhaps will have a GL line for cigars here, so you can see your cigar sales separately, right? So again, we want to drill down on the numbers, of course, right? And we also want to drill down on the percentages. So if you look at month over month, as you can see, the total number is 228,000. It goes up to 286 and then 365. So we have a 25% increase in revenue from January to February and another 26 or 27% increase in revenue from February to March, right? In the hospitality industry, we have our slow months, and January is perhaps the slowest month of the year, and we all know, right? So it doesn't matter which market you're in, you're probably going to have a slow revenue generating month in January. But on the bright side, things start picking up, and February, March, it gets a little bit better and the numbers go up slightly. And summertime, depending on the type of cuisines, if you have outdoor sittings, it may impact your revenue as well. But again, that's on the projections and the budgets, something that obviously we definitely want you to have. So that forecasting will be able to sort of include that as well, right? So let's sort of drill down on the numbers itself. So January, obviously, as I mentioned, revenue was not that great, right? However, the split between food and beverage were still 65, 30, 35-ish, right? And if you look at the trends, it's always around the 65, 68. So keep its consistency. The one thing that I'm seeing after looking at the revenue side here, there is consistency in the split between food and beverage revenue. Again, we always want to see consistency. Consistencies are good. If the number starts moving up, which is even better, the last thing we want to do is see numbers go down. That's the last thing we all want to see as investors and managers and also operators, right? So having this split this is definitely a good split. And the fact that the revenue is increasing definitely helps. One thing that I really like to look at when it comes to revenue is not just the bottom line number, what the total revenue was. I want to look at our average check, and I also want to look at our average total covers month over month basis, right? If covers go down and average spend goes down, then we have a problem in our head, right? It should not be both going down simultaneously. If for whatever reason covers do go down, and however our average spend is going up, then it tells us, yes, the restaurant, we're not seeing a lot of people coming to the door. However, we're able to focus on the people that we have in the building and are able to upsell, right? One area of upselling is, as soon as a table comes and sits down, we often pour them a regular tap glass of water, right? We shouldn't perhaps do that, right? We should, even if we sell a bottle of still or sparkling water, that's $10 to $15 of revenue that we just generated, right? And you multiply that by the number of tables that you have on a daily basis, you now have that revenue needle moving slightly, and it's always going to move up based on that. So there are ways of obviously upselling. You can upsell at the table by setting an extra side, or whether it be a cocktail, a glass of wine, or a bottle of wine for that matter, right? So upselling is definitely important. At the same time, looking at the average check spent is definitely something that we all should focus on. And that is something that we can do daily. You can get the reports directly from the POS. We can generate some reports for you that shows our weekly reports already has that incorporated. It shows you your total weekly covers, monthly covers, as well as your average spend. So when we look at these numbers, we see average spend going up from January to February. That's why obviously that helped generate the revenue up. And then in March, average spend slightly went down in comparison to February. However, we had a higher total guest count, right? So again, the restaurant was busy, servers were not able to upsell more at the tables. However, the bottom line still went up, so we're okay with that, but we do not want that average spend to go down below 84, 85, because that looks like the norm here, right? So that's the revenue. And moving down to our cost of sales area. So cost of sales, if you look at this number, just from a high end or just a bird's eye view, we have a 20% COGS for January, and then 21% in February, and then it comes down to 19% in March. That tells me there's a couple of things. One, consistency. Two, control. Three, efficiency, right? So it looks like Caroline's here, the restaurant is doing a fantastic job with controls and COGS. Again, being able to achieve a 20% food cost or COGS in general is fantastic, right? However, we know that's not how it's going to be for most of us, right? So depending on the type of cuisines, QSRs can be somewhere between 20 to 22%, right? And fine dining can go upwards to 26 to 28% COGS of cost of goods sold. So again, depending on the cuisine, it will vary. However, you want to make sure that you are sub around 20 to 22% and obviously below 28%. A couple of ways to achieve that, right? With COGS, it's just not the purchases, it's also controls and it's also inventory, right? So one thing we want to do is we want to make sure that our restaurants, every restaurants that we're operating out of we're doing inventory on a month-over-month basis, right? Inventory definitely helps because you have your theoretical and your actuals, right? And if you don't have an actual inventory that's being done, we are providing with numbers that we feel like based on the purchases, right? And if you are conducting an inventory, then of course we're giving you the actual numbers. A healthy practice is perhaps to maybe do an inventory once a week, right? And we all know inventory is time consuming. It's obviously, labor as well. So it's not easy to do a weekly inventory for the most part. However, we definitely recommend that you should definitely do an inventory on a monthly basis. So this way we have a physical inventory done. We're able to incorporate that into your cost of goods sold, and therefore giving you a more consistent and an actual number month over month as well, right? So that is definitely important. And just by looking at these numbers here, again, we said 20% food cost, that's fantastic, right? But if you look at the different categories, so we have the food COGS, food food cost against food revenue only. So that means we're comparing apples to apples. We don't want to consider food cost against total revenue because our total revenue is not just food, right? So same thing with wine, liquor, beer, other bev as well. So we're comparing apples to apples. So that is how this P&L is obviously. All the P&Ls are pretty much standardized and done. So when I look at these numbers, I see something alarming, which is the wine cost, right? So if you look at the wine cost month over month, it's going up drastically. Like January to February, it goes up by 6%. And then February to March, it goes up by an additional 3%, right? So by just looking at this, I want to know what happened, because ultimately we're still purchasing the same products, right? Our revenue is not going to change because we're still selling it at the same price. So what is causing this number to go down? Maybe we are purchasing something at a higher cost, or maybe the vendor changed the price for a bottle that we're purchasing, which is our house wine or house tequila or house champagne for that matter, right? So we want to look into that. Also, it could be because somebody forgot to count an expensive bottle of champagne. That's why your inventory is wrong. Thus, it's showing up a higher cost in the P&L, right? Or it could be a formula error on the inventory sheet itself, right? So we just want to make sure that obviously we're looking into these to identify what really happened here, so we have better measures in place. Another reason why we should do inventory, because if you're operating out of a bar or a high-end cocktail bar or a nightclub, with the beverages, it's easy for a bottle of champagne to get lost, theft is another concerns, right? So by conducting a week over week or a month over month inventory, you're definitely looking at what's happening, what's coming in, and what's going out from their premises as well, right? Uh, Another reason why COGS might go up is because of wastage, right? So if it's a food cost that's high or that's going up, we want to make sure that we're able to identify what is causing it, right? So again, there are different areas to look at. Just by looking at these numbers does not mean that we are just looking for something that's normal or normalized. We also want to be able to identify if there's any room or a margin where we can improve, because percentage here and there can really go a long way. Again, if you're a restaurant or a business is operating, I don't know, maybe say $1 million a month, that 0.5% really can move the needle drastically, right? So we definitely want to focus on every single possible ways we can maximize our bottom line, of course. A couple of other ways we see errors are being made. It happens from a POS standpoint, right? Where you may have a new bottle of wine that just came in, and you obviously entered that into the key in the POS. And instead of categorizing that under wine, you're putting it under liquor, right? So that means, although when we're receiving the invoices, we're booking the expenses under wines. However, when we're pulling the revenue from the POS, we're categorizing it under liquor sales because it's mapped incorrectly in the POS, right? So a healthy recommendation for us is at least do a POS audit on a quarterly basis, if possible, right? Or at least twice a year, if not possible on a quarterly basis, just to make sure that the categorization in the POS is also accurate, because we, the accountants and your bookkeepers, are getting the numbers directly from the POSs. So if it's incorrect at that source level, it's definitely going to be incorrect in your P&Ls as well, right? So last but not least, your gross profit for this P&L or this client is around 80% and 80%, which is fantastic. And I'm okay with that number. And I'm sure most of you would be okay too if this was something that you're able to achieve at 20% cost of goods sold, right? For fine dining, that number is probably going to be closer to 72, 73%. Again, that's fine, because we'll definitely be able to make it up on the revenue side as well. So all right, so after gross profit, we have our probably the biggest expense on our P&L, right? And probably the one that we're happy about, because it's our team, is our labor, right? Again, we all want to take care of our staff, we get it, but at the same time, we want to be able to do it in an efficient way, where without hurting the bottom line of the business as well, right? So if you look at this number, the total staff cost month over month, it goes from 45, again, slow month in January, so it's understandable. Not so much understandable, but we could have made some adjustment, which I'm going to go into a little bit more in detail. And then in February, that labor cost goes down to 38%, and March, it goes down to 36, 37%. So just by looking at the numbers, I'm able to analyze, okay, the trajectory is going down because revenue is going up. So theoretically speaking, revenue goes up, cost comes down, it makes sense, right? However, you as operators and managers, you should be able to understand when you're going to have those slow trends, slow months, right? So again, you have to make sure that we're scheduling and bringing in staff based on what we're going to expect for that week, right? So if we know it's going to be a rainy week in Florida, maybe it's not going to be that busy, we should anticipate ahead, right? And schedule accordingly. The same thing with that can be said with the purchases, right? You don't want to purchase in bulk, you want to purchase what you need, right? And with the labor, you also want to staff what you need, not what you think is going to happen just because same thing happened the prior week, right? Seasons change, different holidays come in, which is also a factor. So you also want to consider all of that into consideration before creating the schedules, right? Also events in and around the neighborhood, right? If we're in Midtown New York and the Knicks and Rangers are playing, probably we'll see a little bit more foot traffic this time of the year with the playoffs in full cycle, right? So again, it all really depends on the business, where you are, location, geographical area, right? Also the time of the year. So we really suggest that you really look at your revenue was for prior week, also anticipate what your revenue is going to be for the following week based on that, schedule accordingly. And when you schedule, you should also consider what that total dollar amount is going to be for that forecasted schedule, because we already know what the hourly wages are, what the salaried individuals are going to be. So you should definitely forecast for your labor just like you do for your revenue. Again, that's something that we can also help you achieve by creating a budget. So if you do need help with that, feel free to reach out. We'll be able to assist where required, right? Uh, so looking at this P&L, like I already know there's a problem with back of the house, right? So if you see line cooks, we have 13.5% and then 10.6%. And last but not least at 10.1%, right? So, and if you look at the dollar amounts, it's 30,000, 30,000, 36,000. So by having the 2 months where revenue actually went up by 50,000, our line cooks remained flatline. So that means we generated $50,000 more in revenue with the same amount of line cooks, right? So that's something that we should have probably anticipated in advance and not schedule same amount of line cooks for that week or same amount of line cooks for that month. So that adjustment clearly did not happen here. So that's something where this restaurant definitely can improve drastically, and this number could have gone down. Even 10% is high, on the higher side, right? We want to aim for a lower percentage in terms of labor for line cooks as well. But again, really depends on the concept, cuisine, and what you need, right? So here we could have shaved at least 5 to 6% perhaps, right? As you see, buses and servers, as months go by, again, the number is increasing, dollar amount is increasing, at the same time, the percentage is increasing, right? We understand the dollar amount increasing because you're still generating higher revenue. However, the percentage should come down. Again, we discussed higher the revenue, the lower the cost, right? However, we don't see this happening here, right? So we want to ask our front of the house manager, like, hey, what's happening with the scheduling? Are you staffing based on what you need, or are you just scheduling the same staff over and over, week over week, right? So these are things that we can definitely point out, highlight, and address based on what we need on a real-time basis. Another key area that I definitely focus on a lot is your overtimes. Again, both front of the house, back of the house. So although we have a really high labor cost here, overtime is not that big of a factor. As you can see, we have a total of $700 in overtime for the quarter, right? So again, other areas with some of our other clients, we see this being a real-time issue. It's something that you want to be able to address, take care of, because essentially by paying somebody overtime, you're just, throwing away 1/3 of somebody's salary out the door, right? Maybe we can schedule better and just eliminate that altogether, because essentially that's straight bottom line, right? So overall, I'm really concerned with the labor cost here, and that's something that we'll highlight. And we'll definitely highlight during our P&L presentation. All right, so moving on to, so after our labor cost, that is what we in the hospitality industry like to call your prime cost, right? So prime cost are, again, your COGS, your cost of goods sold, and your labor. So again, as discussed earlier, our prime cost here was right around 60%. That means we have a 40% margin now to pay for everything else, including our rent, utilities, etc., right? Again, we want that number to be somewhere upwards of 45-ish, if possible, or higher. But 40% is something that's going to be hard to manage with all the other expenses. Some of them are big ticket expenses, like your rent, for example, right? So then we have our total staff cost, which includes your workers' comp, staff insurance, staff recruitment. So those are standardized. Staff insurance, of course, in New York, obviously you have to provide insurances to a team of more than 11. Workers' comp is definitely something that you need, so we're not going to take too much time here. Other expenses are marketing, PR events. Some clients, we have seen these numbers, especially for marketing and PR, going to thousands, right? So again, just making sure that we're able to identify what the expenses are and if it's also providing results, right? So if you're paying for, again, we recommend you obviously using PR funds and marketing funds, but just make sure that it's also a result-driven firm that you're working with as well, right? Complementary cost is essentially our booking of anything that's being come to any of the tables. So then that's that cost being recognized in the P&L. Communication 1409. Yeah. And then we have our other big ticket items in the P&L, which are, again, total supplies and cleaning, right? Again, so here we have almost 11% cost. Then it goes down to 8%, and then it goes down to sub 8. So we're seeing that number, although rising, a little bit from Feb to March in terms of dollar amount. It's also coming down in terms of percentages because our revenue is going up, right? Generally speaking, depending on how many line items here, what we're putting in, we still want to see this number somewhere close to 6 to 8% if possible, uh, because some items here can definitely be controlled. When I use the terms controlled, we accountants and you most operators and also managers like to look at things in two buckets, right? And the two buckets are your controllable expenses and your non-controllable expenses. Controllable is everything that's within our realm of control, like our costs, like our labor, like purchasing supplies, right? Like using the cleaning crew that we want to use, for example, right? And the things that are sort of outside of our control are your rents, are your insurance policies, your workers' compensation, right? Because again, we are trying to negotiate before we sign those agreements or those insurance policies with the brokers or whomever we're using. But it's really not much. Once you sign it, it's done deal. You have that policy for a year. There's no wiggle room, right? But in other areas, in terms of our purchases, we'll definitely be able to control that in two ways. One, making sure that we're not going over the budget, right? And we're maintaining our budget, we keep staying below the targets. And two is, whether it can be giving everybody a target like, hey, spend X amount or X% of the total revenue towards that specific supply or other cleaning supplies that you may need, right? So one key area that we often see restaurants run into problems is linen and laundry. Here we see it's sub 1%, and in terms of dollar amounts, it's right around 2,000-ish. And then 1 month it goes up to 2,745. But again, it's still sub 1%, right? So the more covers you have, of course, it's common, you will see the linen and laundry costs go up in terms of dollar amount because more people are walking into the door, right? However, we have seen this number escalate to 2.53% of net revenue, which is a major, major concern, especially with our fine dining cuisines, right? Because that number, that 2%, 3% can really move the needle significantly, right? So we have had clients where they had issues. So first thing we did, we went back and looked at the total linen count that they're bringing in on a monthly basis, they're purchasing on a monthly basis, right? And then we're able to go back to the POS and do an audit of how many covers the restaurant had for that month, right? So generally speaking, you want to have about 1.2 linen use per cover, right? So if you see that number upwards of 2.4, 2.5, that means you're just throwing away linen, or the staff is probably using it just to wipe their hands, and instead of using bar rags, they're using linens, which we definitely don't want the team to do, right? So things like this can only be identified if we're really looking at these numbers, drilling down ways of improving margins and efficiency in the business, and being able to identify it and fix it real time. Again, you restaurant operators have to be able to think on the fly and make adjustments on the fly, because if you're making adjustments 3 weeks later, it's 3 weeks maybe too late, right? You want to be able to look at these numbers, understand, and then be able to take action as soon as possible, so then you can capitalize the following week as opposed to waiting several weeks. Another item that I would like to look at here is the cleaning crew, right? So as you can see, cleaning crew is taking up about 4% of total revenue. And in terms of dollar amount, it's about $2,500 a week, and it goes up to 12,000 for the month of March. Again, it's a 5-week period, so I get it. It's an additional week here. That's why it went up. But around $2,500 a week is essentially you paying for another GM. It's a general manager's salary, essentially, or higher, right? So why use a cleaning crew? Perhaps we can hire a porter, right? So we just want to look at other areas of improvement, or if this is not something that we want to do, we want to make sure that we're able to find out an alternative way to do it. One, by making sure that it's cost saving, too efficient. But again, a cleaning crew may be required because the restaurant is 8,000 square feet, and you need a crew to come in. It's more than one individual, right? However, maybe you can also hire one or two porter to come and do it at $800 a week, for example, right? So we definitely want to be able to identify this and be able to capitalize on it. So cleaning crew is essentially like an additional labor, right? So if you take this 4% and add it to your 45% labor cost, you're now at 50% labor cost, which is just through the roof. We definitely want to make sure that that number is down as well. So again, pest control, garbage disposable. So these are standard. These are monthly invoices. So again, it's flatline, nothing changing. Supplies is something that you also want to focus on, right? Whether it be cleaning supplies or kitchen supplies or front of the house supplies, we want to make sure that that number is controlled and we're obviously staying within our targets and our budgets, right? So if you look at this, cleaning supplies is sub 1%, which is okay. Again, January being the slowest month, we still have the highest amount of purchases. It sort of levels off the following 2 months. So one or two things could have happened. One, we purchased too much in January and we didn't purchase much the following 2 months, or we used a lot in January and then February and March is actually what we used as well. So in that case, January, we probably had a problem here, right? So we want to make sure that we're purchasing based on our needs and requirements. And supplies for front of the house, back of the house. Again, this number is way too high. Dollar amount is too high, percentage is too high, right? So maybe it's, staff is not being cautious with the glasswares, silverwares, plates, right? Maybe we have damages, broken glasswares. So we want to make sure that we're also training our staff, telling them, hey, look, it's okay to take a couple of seconds, slow down. So we're not having to replace supplies time over time, right? Equipment rental could be for your ice machine or your printers, etc. So this is something that we see standard. And if we know it's a monthly invoice, we account for it. And that's just a fixed expense. There's nothing that we can do about that, right? Maintenance contract, depending on repairs. If you have somebody coming in on a weekly basis, that's something that can happen. Summertime, we see this sort of go up because of your HVAC services. So you have somebody coming in through the summer months to make sure that your AC systems and everything is working properly. Or if any repairs need to be done, that's when we say that number sort of spike up a little bit more. So again, these are pretty much standardized P&L, and P&Ls are essentially catered to your need, right? So it can be a very lengthy P&L, and we can have a different GL account for pretty much all the expenditures that you have, or you can have them in different buckets, right? So again, these are standardized, formatted, specifically to your needs and requirements. So again, so total financial cost, we have a 12% and then 10% and then 10%. So again, it's telling me that there's consistency because the management fee is 5%. So that we know is going to be there every single month. Outside of that, we have about another 5% in other expenses. If you look at the payroll processing charges, January is through the roof, which is normal. That's when all the W-2s get issued. So they charge you, payroll companies charge you for distributing the W-2s, mailing them out, etc. And then we see that number sort of flatlines there on the couple $100 on a weekly basis. So which is fine. Credit card charges, we see it's flatlined at 3%, which is fantastic. We often see this number spike up, go upwards north of 3% to 3.5%, 4%. So that is definitely a concern because it definitely adds up. And like I mentioned earlier, even a 0.5% swing one way or another can go a long way depending on the total revenue on an annual basis, right? And if you're having issues with your credit card charges, please do reach out to us. We definitely have some partnerships where we can help you with. We can definitely help you lower the credit card processing charges as well. Last but not least is sales bank, and these are standardized. We're just amortizing your license and permits on a month-over-month basis. So this is for liquor license. And to sort of conclude the rest of the P&L, we have your total occupancy cost, which is your rent and utilities. So these are some things that we have essentially no control over. So refer back to what I mentioned earlier, your controllable and your non-controllable. These are your non-controllable, right? So once you sign that lease, it's final. There's nothing that you can do. However, a lot of managers on call here today, obviously that's something that's going to be out of our control. But operators can go back to the landlord and obviously try to discuss or renegotiate based on your revenue, right? So if your restaurant is not operating year over year the same, you definitely want to go back and have that conversation. But again, if you're in a position to do that, please do so if that helps. If you're able to reduce the rent even by a couple of thousand, which is fantastic, that goes a long way, right? So then we have your total operating expenses at 210,000 or 92%, right? And cost of goods sold was at 20%, which brings us down to a 11.5 or a negative 11.5 EBITDA, right? So now you may ask yourself, what is EBITDA? again, as we shown in the previous slide when Caroline was sharing her screen, EBITDA is essentially your earnings before interest, tax, depreciation, and amortization. Uh, a lot of operators are big. We accountants obviously focus on that a lot as well. So what EBITDA is also known as your four-wall EBITDA, right? So it's everything that is within the four walls of the restaurant that's pretty much within your control. Anything that falls outside of EBITDA is probably most likely going to be either your depreciations or amortizations, right? So depreciations are for your fixed assets, tangible assets, and your intangible assets, right? Like a building or a car, or if you're purchasing an equipment that meets the threshold where it can be capitalized, which is $3,500 or more, then we put it in the balance sheet as an asset. That means that we're able to depreciate that item over the course of its lifespan, right? So a basic GAAP basis, standardized 10-year depreciation method is used. So in that case, we depreciate that item. So say if you purchased a car for 100,000, we now depreciate over a 10-year period. So essentially every year your cost is going to be $10,000 because although you purchased it years ago, we'll be able to depreciate that item over on an annual basis. And amortizations is essentially for intangible assets. So if you have a goodwill or patent or anything like that, that is again amortized over the course of its lifespan. So we're able to do the same standardized GAAP format and follow that 10-year process. So again, this is something that does not have a monetary impact on your month-over-month P&L. However, based on the prior year tax returns, we like to use that number as a placeholder so you know your overall health of the company, what your bottom line is going to be, and there won't be any big or large adjustment at the end of the year to record depreciations and amortizations. Right? So again, so just to recap, like I mentioned, these are completely customizable. We looked at a month over month, right? Again, I generally like to look at month over month in comparison to budgets because I want to know that my team is actually hitting their targets, right? And no other way to look at it by not, of course, by looking at a financial that has the budget also incorporated. If you want to look at year over year, you can also do that. Month over month, you can also do that, So it really depends on how you want to analyze that data, what you're looking for, what you're looking to identify, and what your pain points are. So this way you can go back and address it with the team and hopefully make adjustments on the fly, real time, and making sure that one, service stays the same, right? Two, there's consistency in the operations. Three, you have control. Last but not least, you have efficiency within the business, which will result in a higher bottom line, right? So to recap this financial, again, we do have a concern with the revenue, right? But we know the revenue is going to start picking up, and it already has. I already know what the number was for prior year, which was just around 900,000 year to date. So we're off by 20,000, but again, that's really not something that I'm too worried about, especially when it comes to this restaurant. But I know this number is definitely going to pick up as the months, as we progress in the year, right? Cost of goods sold, just killing it, right? It's fantastic, 20%. I cannot ask for a better margin here, right? So that's fantastic. Kudos to her for being able to achieve the 20% food cost. Again, the margins are fantastic at 80%. This right here is a failure on all fronts, right? We don't want a 45% or a 50% labor cost after considering the cleaning crew, right? We want to see that number sub 35, including payroll taxes, right? So again, that's something that's definitely attainable because as you see in the month of March, we're able to achieve a 36.5% labor cost. And in terms of revenue, it's not even our best month yet, and it's definitely not going to be our best month of the year, right? So I can definitely see this number reaching closer to 31, 32, or even lower, right? So this is the area of improvement. OpEx, this is linen and laundry is good, but the cleaning crew is definitely something that we want to focus on along with the supply. So these are where key areas where we can focus on it. And again, we'll be able to at least drop 2 percentage points or more in just these two categories themselves. Last but not least, rent is sub 10% of net sales. Again, it goes down to 5.7%, which is fantastic, right? So again, this is something that, again, is probably outside of most of our control, but we know as revenue picks up, it's probably going to be around the 5% range, which is fantastic, especially for if you're based out of New York. So overall, although the number is in the negative or in the red for quarter to date at 13,000 or negative 1.5% of total revenue, I am not too worried because I know the next 9 months, the forecasted dollar amount is definitely is good. We're headed towards the right direction. We'll be able to turn things around in the month of April, and this net negative bottom line as of Q1 will definitely be positive by end of Q2. So with that being said, that wraps up our financial or P&L review, and we're open to questions.
Alrighty, thank you so much, Ruhal. So as Ruhal said, we're now open for Q&A. Please ask us anything. If you want to write it in the Q&A chat, or I can unmute you. I see that Joe is raising his hand. Let's chat to Joe.
So
Go ahead,
I
Joe.
just wanted to know if there was a number for variances, that was we want to stay in that range.
Could you repeat that from the beginning? I think we missed the first part.
So, I just want to know for certain costs or revenue producing, if on the variances, is there a range we want to be? Is there a good range?
Yeah, so I mean, if you want, I can take that, guys. So Joe, I mean, typically what we say, anything more than 1% to 1.3% change,
Mhm.
which should be looked into it. And I think good example, I'll give you a couple of good examples on this. One would be, let's say your revenue is going down compared to last year same period. Then you want to look at the covers, you want to look at the average check, and if average check is going down, then it's a bigger question. Like, did we change the menu? Did we change the hostess, etc.? So that is a one way to do it. And food cost and beverage cost is the big one because 1% change in your F&B, and if you're doing $5 million a year revenue, that can be a significant bottom line, right? That's like $50,000 a year in an impact. So if it happens consistently, if it happens like week over week, like 3-4 weeks in a row, that means you have to ring all the red alarms to look into it. That means something is going wrong at all the time. And again, I don't know if you attended the last session, but one of the example can be is a food cost. If you hire a new butcher and the butcher is not following your yield or the wastage standards, you suddenly will start losing more fine products, and your food costs will go up. So you just have to keep on asking questions to each department at all the time to get to the bottom of it. So I would say anywhere around 1% to 1.3% is the range. And if it happens like consistently week over week and maybe a couple of months, that's when you probably want to start digging deeper into it, because this is a penny business, right? Unfortunately.
Thank you.
Thank you so much for the question. Kansu asked, and it's great to see you again, Kansu, thanks for joining us again. He asked if you'd be able to share average cost percentages for restaurants for P&L. Absolutely. So right after this session, we're going to send over the P&L that Ruhal went through. And on the side, I will have like the benchmarks of where we like to see generally, and then broken out between QSR and fine dining because they can be so different. So yeah, definitely Kansu, and thank you again for joining. Any other questions? Anything that you've been wondering? Doesn't have to be something that we talked about today at all. Can also be related directly to your business, can always help other people in that way. Alrighty, I see a raised hand. Lace, go ahead.
Good morning. So on the sheet where you are seeing everything, the revenue, that is all we understand when it's a difference, it's positive or negative. When you go below that revenue, I am still seeing, if I hit my budget and now it's still seeing red. as if it was a negative, but it's actually a positive. Why is that recorded that way?
Ruel, you are on mute.
All right, I'm going to share my screen again. Just, you were talking about the revenue portion or the bottom line, Lace?
It's really actually like in between, right? So if you share the screen and we go to let's just do P&L actual versus budget.
Okay,
So at the top, if you're looking at, let's just look at March, right? At the top in the revenue, you can tell that, we did not meet the budget for our revenue. So in the variance, it's negative,
right, so it's missing the budget.
correct? But if you scroll down and let's just say in March with our front of the house management, our budget was 36,000, but our actual was 16. It's showing negative. Now I know that means that, we did hit our budget, but why is it negative and not positive?
Yeah, no, so yeah, that should have been the other way around, but yes, you're correct. It should be positive 45. So in that case, yeah, which I think there's a formula error here, but I'll be able to fix this for sure.
Okay, so what my question is that that's something that we talked to our team about because it has been like that since day one. So we're just wondering why it always is like that, because if you look, it's like just month over month, that it shows that. So everything in the expense is always, negative when it should be positive. So how do we correct that? And, how does that affect the bottom line?
Yeah,
No,
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 definitely.
so it doesn't. So this is actually correct, just by looking
yeah,
at this. So
Yes, so
revenue,
sorry, I'm just gonna take this. So yes, so Liz, we can change it. Now, typically what happens from an eyeball perspective, people like to see my cost has gone down, so that means it's negative. And some people like you say like, no, I want that number to show a positive impact, then we will do it that way. Negative means my cost has gone down, so it's easy to say, but we can change that formula fairly easily. We'll let the team know so that all your formulas can be changed going forward basis and also historically.
Perfect. Okay. Okay. I was just
And it
wondering
makes
about
sense.
that.
Yeah,
If
it
it
is.
was something that
Yeah.
there's a reason for it and why, if there's why we should not change it.
Yeah, and what happens towards the profit? Profit will be like, let's say a profit went up compared to budget. That will be a positive number with a green sign up, right? So that this has an improvement. So at the bottom, it will be showing plus.
Perfect. Thank you.
Great question, Lace. Thank you. All right, anybody else got a question for us?
Yeah, and I think while if anyone is typing a question, I would just say like I think wage cost is probably the most important after FNB or sometimes before FNB. I think there are multiple ways you can look into those costs and analyze why the cost is high. And some of the way to do it is if like let's say the restaurant is larger and you have two kitchen stations, you probably want to analyze your lunch business much more granularly. So like do you really need to keep both the stations open instead of one station? So if you have a sushi station, do you want to keep both those stations open? And if you have fry station and a grill station, then can instead of having two people work on both the stations, can we actually have only one person work on the station, because we are only serving 70 lunch covers or 100 lunch covers, which is more than enough. So those are the small things which you can do, and which I think one should look at it, because having one less person will be like $40,000 to $60,000 saving in the bottom line. So every small of those adjustments will make a massive impact on the bottom line.
yeah, just,
Yep.
just to add to that, so like what Nish was saying, like even with the scheduling, right? If the restaurant opens at 12 for lunch or 11:30 for lunch, and we don't see first order coming in till 12:45, 1 o'clock, perhaps pushing the team to come in half an hour late, right? That can also help. And that means your prep guys don't have to come in at 5:30 in the morning. They can now come in at 6:37. So if you add 2 prep cooks, which is 3 hours, and the front of the house staff by additional half an hour later in the day. So now you're adding up the, hours in a day, hours in a week, also hours on a monthly basis. So it definitely adds up to be a big dollar amount.
Perfect. Thanks. Hi, Joe. You can go ahead.
Yeah, excuse me. What do you recommend, as far as monitoring labor costs? Like I used to, monitor, review labor costs and where the hourlies were on every Thursday before we went into the busy weekend rush to avoid people going into overtime. So is there like a day, or is there a way that you recommend to monitor hourly employees to avoid the overtime costs? Because that's like an unnecessary cost, in my opinion.
Great question. Great question. I'll give you $1 million answer for this. Um, change your payroll date instead of Monday to Sunday. Change it from
Mm,
Thursday to Wednesday, because most of your overtime happens on over the weekend. And if
mm,
weekend was super busy and Monday, Tuesdays are quieter, you'll be able to flex things much more easier. Because Thursday you are like, I mean, there's not a lot you can do because you need people, even though these things are going to go on overtime. So
mm,
I think that would be one suggestion. And second one is it's a little bit more time consuming. But what Ruhel just mentioned is you really want to analyze like what time prep cooks are coming in the morning. If your prep cooks
right.
are coming at 5:36 in the morning and your lunch business doesn't start really until 12:30, then just start adjusting 30 minutes, 45 minutes and see how does it impact. So that is the second one. And third one, what I mentioned earlier, is look at your sales analysis mix during the
Mm,
lunch and the dinner and during the slower days, because sometimes you have stations, so you think like these are the 10 people I need on these 5 different stations, but not necessarily, because you can start combining 2 stations into one because you don't get as many tickets during the lunch or maybe early dinner.
mm. Thank you.
Thank you, Joe, for your question. Any other questions? I think we.
Good. Yeah, we have one question.
David says, Nish, the best recommendation. It's hard to manage labor on the weekend when everyone is going into overtime.
You're welcome, David.
Absolutely.
Thank you.
All right. I think if there's no further questions, we're going to wrap things up. Thank you guys so much for joining. If there are any other topics that you want us to go over, or if we talked about something you want us to do a deep dive, we totally would love to hear your feedback. If you liked this session, if you didn't like this session, we want to know so that we can deliver what you guys need to hear. If you have any friends, colleagues, anybody who needs help with their restaurant finances, please do not hesitate to reach out. We're always trying to help other restaurants improve with the tips and tricks that we've learned. So thank you so much for your time today. We're going to be sending out, like I mentioned, the webinar recording, and then also the P&L that we went over with US benchmarks. So thank you so much.
Sorry, Caroline. Joe has one more question.
Yeah, I just want to know, is this because this was the first session that I joined, and there were a few that I missed before. Will there be ones more in the future?
Yes.
And is there a set schedule? And if so, can you send me that so I know?
Absolutely. So we're generally doing these about once a month. We don't
Okay.
have a set schedule, but I can definitely put you on our list and make sure that like you're one of the first people to know about it. If you want to catch up on previous sessions, they're on our YouTube channel, Paper Chase. And I can also link those in the thank you email that I send out to everybody. So yeah, I will absolutely be having more sessions about once a month, and we'll let you guys know.
Oh, thank you very much. Yeah, if you could add me, I'd appreciate it. Thank you.
Absolutely. We'll add everybody on this list and thank you guys for joining today.
Thank you. Thank you, Tim. Thank you so much.
Thank you.